Good morning, everyone. Thank you for joining us for today's webinar, revealing the state and local tax consequences of a remote workforce, the digital age of state and local tax, presented by Rea Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I will be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. When you receive this email, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenter. Your feedback is important to us as we determine future webinar topics. Also, if you'd like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Today's presenter is LaMonica. Kathy joined the Rea team in 2018. She is an income principal in the SALT Technology and Consulting. Her focus is on sales and use tax consulting, compliance, and implementing technology solutions. She is a certified implementation specialist for Avalara and Vertex Sales Tax Solutions. Kathy assists clients with all matters of state sales and use consulting and compliance projects. She earned her bachelor's degree from St. Mary's College and has over 18 years of experience in the tax industry. And now I will pass it over to you, Kathy.
Thank you, Imani. Good morning, everybody. Welcome. Again, as Imani mentioned, this is revealing the state and local tax consequences of a remote workforce, or as I like to say, another episode of how state tax obligations can wreak havoc with your business. So I think every time we talk about something new with state and local, everybody sees me as the doom and gloom girl, as bringing all the bad news. But basically, what I want you guys to get out of this presentation today is how to, when you have a new remote employee, how you address the state and local obligations that are going to come along with that. Abby, go ahead and slide. Thank you. So, what hasn't been said about COVID, that someone else hasn't already said it. So obviously, COVID has changed a lot of things for us, and in the last 18 months, we've learned a lot about how offices and businesses operate, whether remotely, virtually, in person, and whatnot. And as there's a definite migration of the workforce due to the influence of COVID and where we have been in the last year and a half, it's interesting to see where this is going to go and how it will change the business world forever. But I read in an article, CNBC, a study from late 2020 that says that estimated 14 million to 23 million Americans are planning to relocate to a new U.S. city or region on a permanent basis. Obviously, some of this is just, natural movement, but driven by COVID, initially, companies and employers are understanding the benefits of having a remote workforce. They're understanding, potentially lower operating costs if people are not in the building, less rental space costs, and increased employee availability and job satisfaction for the employees. Companies of all sizes are adopting a remote work policy. Our firm as well, we have a work from anywhere program that we can apply for to be a part of, but there was a survey that 57% of small and medium-sized businesses plan to offer a remote work, a work from anywhere, some hybrid flexible plan. And another issue that we have all been made aware of through COVID is just recruiting new talent and trying to find talent. Well, now the work from anywhere, the remote employee force, we're allowed to, and we can seek out people who aren't traditionally in our circle. So we've been looking at, recruiting from any other state. We have interviewed people in Minnesota for a tax position, people in Missouri for a cyber position. So we're looking at different avenues of recruiting, as well as having a hybrid flexible plan is allowing us to keep some of our great talent. We had an individual recently who moved to Arizona, but she's still working full-time for Rea. So All of our clients are facing the same type of, looking for help, looking for people, and all the people that we're talking to and interviewing and recruiting for, first and foremost on their mind is, can I work from home? Can I work from a remote location? So it's a huge issue that has to be addressed, and we have to keep, we want to keep our workers happy, but we also have to make sense for our businesses. So some of the things, next slide, please, Abby. I want to focus on, this. When you think about a remote employee, you're thinking about payroll taxes in other states. This is not just a payroll tax issue. This affects so much more on the state and local level, tax level, than just payroll taxes. I won't get into all the issues of, how do you keep teams bonded or the cultural stuff that goes along with having a remote workforce, but just the business aspects alone of when you have a new employee or a direction of having remote employees outside of this state, and not only just outside of the state. You have to think about Ohio too, outside of the city, outside of the local office that we're working in. I'm in the Cleveland office now. I live in Chagrin Falls. We're doing the hybrid stuff with different cities, and that affects Ohio as much as it does when you have multi-state. Next slide, please, Abby. So some of the state tax issues that we talk about with a remote workforce. Obviously you're thinking about remote workforce employees in other states, but there's a lot of things to consider when you start talking about having an employee in other states or working in other states. In the last year, I have seen an uptick of payroll applications. People are coming in and our clients are saying, hey, we have a new guy who's moving to Tennessee or to Georgia. How do we, we need to get them registered for withholding. And that's just the tip of the iceberg. So when we get those application requests and we get those payroll applications, the first thought that we have is, okay, do you already have Nexus in the other state? Because having that employee will give you Nexus in that state. You have to start thinking on an income tax level. If you have Nexus for income tax level, how are you sourcing your sales to that state? Taxability of products and services. Are things that you're doing in those states actually taxable? If you have an employee who might be working, as an admin person in a state in which you have no sales or no actual customers, maybe it's less of an issue. But if you actually have activity and business activities in that state already, you have to consider, what do you have already and how does this affect it? Is the employer required to withhold state and local income tax for remote employees? In Ohio, for other cities? What about workers' comp, unemployment insurance? There's so many rules that go along, and there's some reciprocity agreements with different states, but it depends on the facts and circumstances of that particular transaction. Also for the employee, and I think this sort of gets passed under the rug a little bit, but is the employee required to file new additional tax returns? Are they aware of their responsibilities in a new state? There was another survey that said 7 out of 10 remote workers were unaware that working remotely could affect their taxes. And if you think about it, some people, we're in the tax business, we're in accounting, we're more aware of different tax rates and withholding rates. But someone says, hey, I want to live in New York, and New York withholding being a lot more costly for them, they're going to have more of their paycheck taken away for withholding. So does that bring up the conversation? Well, I need a pay raise, or maybe I shouldn't do it, or all these other things that go into it because of the employee's new costs of where they're moving to. We think about remote workforce and what some of the stuff that I've been reading and hearing about is people are leaving like New York City, where it's really expensive to live, and living in New Jersey so that they can have, pay less rent and still do their job. And that's going to affect New York taxes and what they're bringing in. And it's going to affect office space in New York and being, there's a lot of cyclical and sort of domino effect of what happens when people start moving into these other areas and away from the big cities. But the employees also have to know, what are your requirements and what is responsible for them. Next slide, please. So to start this all off, and I talked about Nexus as being, one of the things that we have to deal with on a from a remote workforce perspective. But Nexus, and I'm just going to define it, even though most of you out there probably already know what Nexus is. But a lot of times when I'm having these conversations, people ask, what is Nexus exactly? Well, it's the connection that between the taxing authority and an entity that ensures that they, or verifies that they have enough connection to require the obligations of tax for income tax, sales tax, payroll tax. Nexus is that connection between the state and the entity. So when we talk about Nexus here, and I think first and foremost, if you don't know, having a remote employee in another state pretty much guarantees you have Nexus in that state. That is your typical physical presence factor that's being initiated by having that employee. But I think when you talk about, I'm going to send an employee into Arizona or Colorado or Nebraska, and you think, okay, I'm going to have Nexus now, but you have to consider, did you have Nexus before you even sent that employee in there? Because as you're registering, as you're getting compliant with the states, you have to consider, did you have it before? Is the state going to find out that I had Nexus before? And in the past, when we talk about Nexus, and I'll go into physical presence a little bit more, but now we have economic Nexus with Wayfair, and then there's other Nexus standards that have mostly started to be refined and retracted and amended because they're not necessary with physical presence or economic. You're basically getting your businesses one way or the other. But those factors were always, physical presence was always in play for as long as I've been working. So physical presence never went away, but now with the added economic, you have to consider, did you have risk or did you have exposure before you're sending your remote workforce into other states? Next slide, please. Okay, so physical presence, like I said, you have an employee, your remote workforce, that's going to give you Nexus almost instantly for sales tax, for income tax. There could be some protections under Public Law 86-272 from the income tax side. But if you have a permanent person there, it's not just sales reps necessarily. It could be other types of employees that would give you Nexus. Franchise tax, gross receipts, those don't play in the same Public Law 86-272 protections. So those you have to consider. And the remote workforce, we talk about permanent people, people moving permanently to other states. But in the past, you've had temporary employees who have gone, or employees who have gone temporarily to other states, whether it's for an installation project or construction project, whether it's there to do surveying work in different states for limited periods of times, whether it's sales reps that are, going and doing, whether they're related to you or independent contractors, all of those employees, subcontractors, third-party, unaffiliated, independent reps, all of those are creating physical presence. And if you've had them doing things for a number of years, you've had physical presence for a number of years. And you need to be aware of that before you start registering for other taxes. The other parts of physical presence that most people understand, if I have a warehouse or if I have an office or if I deliver trucks, deliver in company-owned trucks to different varying states, that all gives you physical presence Nexus. That all has triggered Nexus in the past, whether you're in there and compliant or not. The other one I wanted to touch upon is, I've heard people have, well, I have a warehouse, but I don't own it. I just store my inventory there. Inventory is going to give you Nexus for both sales tax and income tax. And Amazon FBA, if anyone online is doing business through using Amazon as a fulfillment or any other agent as a fulfillment, that can trigger Nexus. And there are some very aggressive states who have gone after the remote sellers who are using Amazon FBA and saying you've had Nexus. I heard a story recently where a person had business, was using Amazon since 2012. They got a notice from California saying you've had Nexus for the last 10 years. Here's your assessment for all the tax you didn't collect when you should have. And it's really hard to fight those. There's a couple states who have come out with amnesties to protect those types of sellers who have been using. I think Pennsylvania had one recently. I don't know if it's still open to take advantage of it, but they're saying, even though, and with Amazon, if you don't know, Amazon moves your stuff all over the country. So you could have Nexus in 36 states and you have no idea where your inventory is. And there's a lot of people that say it's super unfair that a state would say you have Nexus, but a lot of the states still look at that as enough of a trigger. So physical presence has always been there. Next slide. One of the things that I wanted to talk about with physical presence and remote employees, especially, is during COVID and the emergency regulations, you know, an employee triggering nexus. As I mentioned on the previous slide, you know, as soon as you have an employee there in that state, working in that state, it's triggering nexus for your business. During COVID, some states, but not all, said that a temporary remote employees would not trigger nexus for sales tax or corporate income tax. It's temporary exemptions that were put in place to be in effect basically while the emergency orders were in place. So, and, you know, once lifted, it's typically understood that the standard physical presence rules would apply and would be in effect. But I will say that these COVID emergency regulations were inconsistent, to say the least. A lot of states didn't provide guidance at all. They didn't address it. Some states emphasized that COVID made no difference. If you have an employee working there even temporarily, you now have nexus. Some would say it's, you know, the emergency regulations would cover corporate income tax, you'd be protected, but not necessarily sales tax. So they've been all over the map, and I have charts and documents that are being updated to be able to show who had it and when. But I think to keep in mind is there's basically no guarantee that that was going to be enough to cover you or keep you out of a nexus established state. Payroll taxes, again, they also had some states had some an exemption due to COVID that you didn't have to withhold at the other states. Or there was, you know, for payroll taxes for employees working there because of COVID. Some states, and this isn't a COVID rule, but some states have the convenience of the employer rule, which basically means no matter where you are, if your business is located in one of these 7 states that I listed, Arkansas, Connecticut, Delaware, Massachusetts, Nebraska, New York, and Pennsylvania, the employer basically can source all the wages and withhold at that location of their office, not necessarily where the employee works. And there's a big case, and I think it was denied cert by the Supreme Court. New Hampshire sued Massachusetts because they did not like, Massachusetts has this convenience of employer rule, said anybody who's still working for a Massachusetts business but living in New Hampshire is still going to have Massachusetts withholding taken out of their paychecks. New Hampshire thought that was an overreach, that it was challenging because New Hampshire doesn't have a personal income tax. It was unfairly, you know, applying withholding and taxing income that wasn't made in Massachusetts. It's being earned and the benefit is derived in New Hampshire. So it went up to be discussed at the U.S. Supreme Court, but they denied to hear the case. And I know that there's other states that are having similar issues and was very hopeful that the U.S. Supreme Court would take that case because they wanted to see, you know, how it went. New Jersey has the same effect with New York, where New York will, no matter if you were working in New Jersey due to COVID or anything else, New York will withhold New York withholding. You can get a credit towards your taxes, but that means New Jersey loses a lot of income and New York is making income tax on wages that aren't even being earned in the city. So it's a very contentious issue, but it just goes to show how inconsistent and varied the state rules are, and you really have to understand how it impacts and how you need to figure out how to make it work when you have an employee in one of these states. Most states, though, for COVID did not provide any guidance and emphasized that it made no difference to whether you had nexus or withholding. If you had an employee there, you were supposed to follow along with the rules as previously written. So I want to talk about Ohio here because obviously we have a lot of clients and customers and clients and customers and people who are listening to the webinar, and in Ohio, obviously we're in Ohio, so we want to address this. And Ohio has the municipal income tax, There's been a lot of court activity and a lot of different legislations and bills that have come up. And basically, same issue as what I was talking, like kind of New York and New Jersey. You could equate it to a city where, you know, say Columbus, everybody's working in Columbus, works for a Columbus business, but they're working outside of Columbus at their own home location, and how that affects personal income tax from a municipal income tax update. Well, as of June 18th, because during COVID, during the Emergency Act, there was protections in place to allow those cities to still withhold, or the businesses to still withhold from the local of where the business is located, not necessarily where their employers were or employees are working. And it also limited refund claims that were due to COVID for the employee who's now working in a different location. So as of June 18th, the COVID-19 state of emergency was lifted, and those protections would have been lifted effective 7/18/2021. It was 30 days after the state of emergency. Those protections would have gone away. However, Governor DeWine signed the budget into law, and it allows for a partial win for all parties. But what it basically said was it's going to extend the protections that were in place during COVID through 12/31/2021. So it allows the employer to keep withholding at the employer location city. But effective 1/1/2022, you need to have a plan in place for employees that are intending to make a permanent remote work situation. So, you know, you're covered through 2021, but as of 1/1/2022, if you have employees who are now going to work in a different location than they previously have, you need to build in the structure and the capabilities of being able to withhold, if necessary, from their local where they're physically located. And then there's the normal 20-day withholding rules that will apply, where if the employee has to be there, I believe 20 days before the withholding has to start. For the employees, as we mentioned before, like you couldn't, during 2020, you couldn't apply for a refund for 2020 if you were working, if it was COVID related, if you hadn't, you know, physically moved for other reasons. But for now, they're going to allow qualified employees to receive a refund of taxes withheld to a municipality where they neither live nor physically perform services for the calendar year of 2021. So I think employees would have liked to have seen this go back through 2020, but it was pretty clear that no refunds right now are allowed for 2020, and the courts are deciding this. So it's given the employers a little bit more time to figure out how they're going to handle this going forward, and it's given the employees the right to request refunds for 2021. But there's still some unanswered questions, and there's still a lot for Ohio employers to figure out how we're going to do this going forward. You know, one of the biggest things about you know, being able to withhold at different locations is, do you have software that can do that? Do you have a payroll company who can handle that? You know, how are you going to address that? How are you going to do it when it's a temporary thing? Like if somebody's working in the office 3 days and you have somebody, you know, working in the office 3 days, working at home 2 days, and it's 2 different tax rates, how is there a system that you can have that they're identifying which days so that you know the withholding is being handled properly? So as I mentioned before, once those COVID protections go kind of off and the emergency acts are over and the COVID protections and everything goes back to normal, now you have to consider what is normal. And now I have a remote workforce, people who said, you know, I like working from home now, I'm going to stay working from home, we're going to make this work, it's a different state. Now you have to look at what are the actual rules, and as people start to make these choices, how quickly do you have to get on board with the payroll obligations? This chart, this map shows the income tax withholding friendliness, basically under normal conditions. So this is not COVID related, but this is how the states prior to this, and now we'll start to shift back into, for those who had special rules, how are they going to determine when withholding has to start? So the very friendly states are the ones that give you 30 or more days before the employer is subject to withholding tax. All down to the very unfriendly, who have, I think there's 24 states there that requires the individual to file on the first day, even if the employer isn't required to withhold on that first day, which is like New York. But so some of these states are going to be harder to get compliant and follow the rules right away, just because they give you very little time to get going. So as you're considering your remote employee and you're looking at these states, you have to think, okay, I need to have this done before they even move there, or I have a little bit of time to get it going. But it's all these things that go into it, planning out how we're going to handle this. And this talks really, this chart is really about just withholding. You have to consider the implications of unemployment insurance, or workman's comp. How are those handled? Can you use, your workman's comp from Ohio to cover an employee in Arizona? There's different rules, and different states have specific requirements. The UI as well. There's some states with reciprocal agreements, but generally it's more the related states around you, and it may vary on whether that employee is temporary, or like just going into the state from here and again, or permanently located in that state. So I'm going to jump over to the economic nexus a little bit right now and talk about Wayfair and give you kind of an update. There's a lot of information out there. Wayfair's been out 3 years. For those of you who aren't aware, Wayfair was a case settled by the U.S. Supreme Court, Wayfair versus South Dakota, back in 2018, and it was just around this time. So we are 3 years later. I've never seen states jump on board and do the same thing all at one time like this ever before. Wayfair seemed to get every state on board and say, except for Missouri and Florida, and say, yes, we need to do this as soon as possible. So the pre-Wayfair decision, back before June 21st, 2018, the states in purple on the left and on the map are the ones who had some sort of an economic nexus legislation out there, or had something enacted, but it wasn't really pushing, it wasn't really, it was still being challenged by a lot of different organizations and agencies because most people didn't really see that it was fair. And then South Dakota, obviously, versus Wayfair, they took Wayfair, the company, to court over these rules, and they went all the way to the Supreme Court. So when it was all decided, they came up with some rules for establishing economic nexus legislation, and basically it was 100,000 in gross sales or 200 transactions. Now, the map on the right shows that every state in purple, the ones that are in gray, don't have a sales tax, so that's why there's no rule there. Every other state, except for Missouri and Florida. Florida just signed theirs into bill, and it was active July 1st of this year. So that was one of the stragglers. Missouri actually has a proposed legislation, and it just hasn't been signed by the governor yet. So it's still out there, but it's expected to go through, and it's expected to be enacted 1/1/23. So you still have some time in Missouri. But every other state has come on board with some semblance of the same type of rule. Now, over the last 3 years, it's changed a lot from where it began, in the sense of some states have completely dropped the transaction requirement. They didn't want to punish little businesses. They didn't want to say, if you're selling widgets, but they're low price and they're not, it's not, basically the states are like, it's not worth our trouble to have those companies register, because they're not going to get the revenue from it. For the states that, are bigger, California, New York, they upped their gross sales threshold from 100,000 to 500,000, because again, they didn't want to penalize the smaller businesses. They didn't want to, go after all that. They set their limitations higher. And now there's also a varying degree of what's included in the gross sales. There's many states who are saying not gross sales, they're saying taxable sales. It has to be taxable retail sales. They're trying to prevent a company who only sells sales for resale from having to register and file 0 returns. But there's many states that still say, nope, your gross sales. I don't care if they're sales for resale, you still have to do it. I don't care if you do exempt services, you have Nexus, you should register. So there's a lot of variety in the rules that we see, and we are constantly trying to keep updated and make sure that we're not advising somebody to go into a state that is not necessary from an economic nexus perspective. The other one I wanted to mention here too is Kansas. When they first came out with their rule, they had 0 threshold. So it was like one sale for $1 and you had Nexus in Kansas. They have since modified that to be on the standard 100,000 of sales. And I'm not sure offhand if they have transaction threshold or not. So Wayfair coming out, and then the marketplace facilitator laws. I'm just going to touch on that for a second, just because I think there's a lot of misunderstanding out there. If you're a business that sells through Amazon and through your own website, through your own platform, through a multiple of platforms, yes, the marketplace facilitator laws tell you that Amazon has to collect taxes on your sales in those states. And as you can see from the map, pretty much everybody has a marketplace facilitator law. But if you sell through your own platform, you have to be aware that you still have that compliance. You still have that Nexus requirement. So you need to be very aware of how you're selling. If you're selling through traditional sales reps, traditional, somebody calls up and does an order, and Amazon, you have to make sure you're accommodating and taking into effect all the aspects that are responsible by, who Amazon's responsible for, and your own responsibilities, and when you have to file and register. There are states out there now that says for Nexus, you have to include your marketplace sales in your Nexus calculation. So you can't just drop that out and say, oh, our sales to this state are minimal. You have to include that, even though at the end of the day, Amazon's going to be collecting the tax on that. So these are good to keep in mind that they're out there, but you need to make sure you're talking to somebody about how it affects you, and does it allow you to not register, or do you still have Nexus? Do you still have to register and still have to figure out how to file and report these sales the proper way? Next slide, please. The other Nexus standards that I wanted to talk about, and I just briefly will say, so these were all pre-Wayfair, and they've mostly been retracted or rolled over, or not a big deal in a lot of states. So Cookie Nexus was in Massachusetts and in Ohio. Ohio eliminated after the Wayfair because it got rid of it. Massachusetts overturned it finally. But Cookie Nexus was basically, they were saying you had Nexus if someone logged onto your website in Nebraska, your company now had Nexus in Nebraska because there were cookies on their computer. And it was just one of the ways the states were trying to get this internet seller aspect before economic nexus. Affiliate nexus is really related to the activities of your affiliates in other states, if they're acting on your behalf, if they're referring, if they're selling similar products and advertising for you. If you have related entities that are doing services for you in other states and contributing to your sales, it was affiliate nexus. It's been repealed in 3 states. I would expect more states to follow suit and repeal those Nexus standards too. And then click-through Nexus was really pre-Wayfair. It was if you had a click-through, like if people were clicking through your Amazon site it would give you Nexus. It was kind of the way of saying if you had sales through Amazon, you had Nexus in that state, and the threshold was really low. It's like $10,000, so it was very low. But for the most part, click-through Nexus has been repealed in some of these states. Apparently, Illinois repealed it and then recently added it back in. I don't know all the facts and details about that, but once you start looking at just the main components of Nexus, of physical presence versus economic nexus, you're going to have Nexus usually through one of those methods, and those are the primary sources. Okay, next slide, please. So I want to touch base quickly too about business to business manufacturers who sell to distributors or sell other parts to manufacturers or service providers and Nexus, I get a lot of questions from clients who say, you know, all my sales are for resale. I'm selling to manufacturers. Do I really need to register? Or why does it matter? And same thing with service providers. If you have, you know, a consultant that goes into other states, you know, physically you have somebody who's there doing work in that state who's performing services. But those services might not be taxable. They might be professional fees that aren't taxed. I think keep in mind that there are some states that first still want you to register, even if your sales are for resale. If you've met those other Nexus economic factors, even if your sales are for resale. And some will include exempt services, some will include sales for resale in those calculations. And you also can't automatically assume that what you're doing isn't taxable. I think some of the states are getting more aggressive, and we'll talk about that in a minute, about services in general and taxing things that had traditionally not been taxable. So you have to consider, what am I doing in that state, and maybe it's still necessary. Again, when you have a manufacturer who's selling to distributors and sales for resale, the thing is if you're selling something tangible, a tangible piece of product to somebody, and it's only exempt because they're reselling it, you have to get the right exemption certificate on file to exempt that sale, or it's a taxable sale, and that onus is on you. So you need to be aware of those implications. And it becomes, with those types of businesses, not necessarily a sales tax software to calculate the tax, but how do I manage those certificates to protect me in case a state will audit me for not having the right documentation? And so there are things to think about, even if you have a remote employee who's going into California and you know most of your sales are sales for resale or to manufacturers. Well, one, your sales to manufacturers, if it's equipment, is still taxable. There's a partial exemption in California for manufacturing. If your sales for resale, you have to have a California resale certificate with a California valid permit in order for it to be an acceptable document. So there are things and landmines that you got to be aware of, even when you're not traditionally just a straight seller of tangible personal property in these states. Next slide. So when we're talking about once Nexus is established and now you have an employee there, so you've either met Nexus just because you have economic Nexus from, you know, the Wayfair case and your sales are high enough. Now you have an employee going in. Once Nexus is established, you have to figure out, you know, am I selling something taxable? Are my services taxable? How am I going to figure out the tax rate in California when there's 5,000 jurisdictions and I could be shipping anywhere in California? The varying rules from state to state of even things that you're selling or services that you're doing can be very complicated. So you have to figure out, I have an employee there now. I've already had economic Nexus. I have to figure out, do I have past exposure? Do I have past tax exposure? Because say the economic Nexus rule went into effect in 2018, I might just have a remote employee there now, but I had economic Nexus since 2018 because my sales were high enough. I have to consider that whole period. Do I have risk? Because when I apply for a payroll application, sometimes it asks Nexus questionnaires, and it's going to ask for your sales for the last 3 years. And it's going to try to determine, the state is going to try to determine if your effective Nexus date is really when this employee is starting, or did it happen 2 years ago? And is there a potential that you had tax that you should have collected or gone forward? Again, the sourcing of income for income franchise tax compliant, where the person who's moving, are their services now being performed in that state? How does that affect the apportionment on an income tax return? Past risk and exposure, once you figure out your tax, if there was tax exposure, there's ways to mitigate that. And if you need to do a voluntary disclosure, if you need to approach the state and say, I had Nexus from 2 years ago, I owe this tax. If you've already registered in some states, even if it's for payroll, you're precluded from approaching the state from a voluntary disclosure. So you're not allowed that option, which means that if they find out that you've had Nexus in the past, you know, the penalties and interest alone will be pretty high and could hurt you. Payroll tax compliance, once Nexus is established, you have to know that you have the system to calculate the new withholding rates. You have to know that your payroll company can handle these things and get registered. And then compliance going forward for any of these taxes, outsourcing, whether that's the option. Do you have an internal resource that can handle it? Do you have the right softwares in place, either in your ERP systems to handle it, or do you need add-on modules? Do you need other systems that are going to help you manage this process? Next slide, please. So the reason I bring up all the Nexus stuff and in conjunction with this new migration and the workforce moving to different states and different cities is it's a perfect storm. Wayfair's 3 years out. Your remote employees are triggering Nexus almost immediately, and states, although they're making money from these new Wayfair rules and the people who have gotten compliant, they are still being pretty aggressive, not only for enforcement and finding people who haven't registered or haven't gotten compliant, but also expanding their tax base and the taxability of services and digital products. I mentioned, the tax base adding more services than ever before. Taxability of services and digital products. Software as a service, SaaS, is a huge gray area in a lot of states, but they're starting to take a look at what that means when people are accessing different softwares in different states. Ohio is very aggressive on computer services and software as a service and things, that are informational, and taxable and computer services. But a lot of states have still kind of said, well, if they're not getting a floppy disk, then it's not taxable. But you have to be aware that those things are changing. And through COVID, we all streamed a lot of Netflix and a lot of YouTube videos. And now, how does that affect the state coffers and the fact that they could get more money if they tax those streaming services and they tax those digital products that are transferring to customers in all different states? States are getting very aggressive with how they're finding taxpayers. Nexus questionnaires, I've seen a huge uptick. Phishing, just saying, hey, we think you are in this state. Can you please tell us why you're not? And if you ignore a lot of those notices, or if you ignore, don't respond, or don't answer, they can get progressively more aggressive as far as, if you don't respond, they might say, well, we think you are, so here's an assessment. If you don't respond to that, here's another assessment. Here, you have this amount due now. It's up to you then to prove that you don't have Nexus, don't have taxable sales, whatever it is. So get people involved, get us involved, get somebody having a look at what they're asking before you respond right away, and we can help you through that. But clients need to figure out ahead of time, what landmines might be waiting for them and how to mitigate the additional costs that might be associated with a remote workforce. And I just wanted to touch on this a little bit. I know we're coming up soon on the end of time, but aggressiveness of the states, the director of the multi-state commission came out with a remote paper about remote sellers, and they are presuming that it's likely that less than half of remote sellers are actually complying with the Wayfair rules. So as I mentioned before, states are getting more aggressive. Arizona is bringing in a private data analytics company to identify non-filers. Some people are questioning that is, legal, but they're doing it, and we're going to see where that goes. I mentioned states are expanding the tax base. Vermont is thinking about taxing food, which typically is not a taxable thing. There's still some areas of the country that do tax it, but at a lower rate. And they're generally not targeting the key nutritional components of food that you're buying. Nebraska is another state that's adding services to their taxable base. There's a few states that tax pretty much all services. So you have to be aware of those. Maryland and Colorado, Maryland came out with a big digital advertising, taxing digital advertising, banner advertising, search engine advertising. I think it's still being challenged, but it just shows that they're moving towards these more digital products, stream products, how to incorporate them. Typically in the past, for property to be taxable, it had to be a tangible piece of property. And that's where you talked about you know, a floppy disk or a CD that you got with a game on it. It was taxable if it was tangible, but if you got it electronically, it wasn't. They're readdressing and redefining those rules. And digital downloads and streamed content is already taxable in some states. And at Maine, I think it was at a reduced rate. Now it's, you know, raising the rate. West Virginia had an interesting proposal that I think is unlikely to pass, but they're seeing all the sales that are going through the internet and the decline in the traditional brick and mortar sales, that they wanted to tax the internet sales fee, like attach a fee to sales that were going through the internet if you're buying something online. Unlikely to pass because they're going to say that's not fair, but and you know, it's the way of the world, the way we're going. So I'm not sure that that's going to go forward, but it's just interesting that they're looking to even think about doing something like that. Next slide, please. One of the other polls that I read that was kind of alarming was that CPAs, it was a poll of CPA and accountants that suggested that 98% of small businesses are failing to fully comply with all the interstate sales tax issues they may be liable for. And I think a lot of us in the business a long time, you know, we've always had clients and people who say, you know, let them find me. And that still might be, you still might not be on the radar of any state, but I think you need to be aware of what your footprint is and potential liabilities, and then you know better to make those decisions, especially when you have somebody who wants to work in that state now, because that's going to open the floodgates of other stuff if you're not paying attention. So you want to know that picture of where you are and what risks lie in front of you. I just want to do, I think we're kind of time, but I think the test case here, just sort of like if you're thinking about having an Ohio company has 5, you know, personnel moving to 5 different states, all the things that you kind of have to think about. You know, the company sells software and computer services. Software may or may not be taxable depending on how it's delivered. Services may or may not be taxable depending on if it's professional versus management service versus implementation. Employees in all these other states now have property in those states, laptops, equipment, software that might be taxable. Property tax concerns in some states. Employee withholding in all these states, payroll tax, unemployment insurance, workers' comp. And then the questions that you ask yourself: did you have Nexus before the employees moving there? Is there past exposure? Have you ever been contacted by the state as to whether you have Nexus there? Are you eligible for a VDA? Do you have internal systems? This is a big one. Do you have the systems capable of handling the sales tax collection, filing, and tax determination if you sell something taxable? Do you have the people that can handle the multi-state compliance and responsibilities? Can your payroll company handle multi-state withholding? Do you have a way internally to track where people are in withholding for employees specifically? Next page, please. Calculating the cost is kind of just, I'll touch on it, you know, so some of this sales tax is a pass-through. You're collecting from your customers and remitting to the state. Income tax withholding, your employees are paying it, but you're withholding for them. Taxes and expenses on the business though, and this is for anybody who has remote employee, you might have income and other direct taxes, franchise, gross receipts, business privilege tax, B&O, property, unemployment insurance, any new software technology to handle it, and then if you need outsourcing or dedicated employees to be able to handle the multi-state operations that you may be having. The next slide, please. So why should we comply? That is a big question. A lot of small businesses, that's come up recently for me, clients that are thinking of selling, their buyers are coming in and doing the due diligence. They're looking at economic nexus. When did their sales tax economic nexus kick in? Do they have past exposure? And they want them to address it before they will consider buying. They don't want to take the successor liabilities on themselves. So they're asking the questions and doing their due diligence. And you should be aware, if you're thinking of selling, to get ahead of this stuff. What do I need to do so that this doesn't become an issue in a sale? Again, if a state finds you before you address it, there's little room for waiver of penalties, and you can't go back for the taxes and the interest. You know, you can't go back to your customers from 3 years ago and say, sorry, I didn't charge you tax, I should have. Here, you know, here's a bill. It's not going to happen. If the state finds you, there's no statute of limitations if you have physical presence factors going back. So if you had anything else that was triggering physical presence besides the current new remote employee, you could have past exposures. States have unique and aggressive ways of finding you. They could audit your customer or your vendor and see that their tax wasn't charged or paid, and they could start asking questions. They share information between the state and the tax departments, and even from state to state are starting to share a little bit more. Data analytics, they're looking at, Indiana a couple years ago, I think, was sending out letters based on credit card receipts of sales into the state and finding phishing that way and finding people to get compliant. And then Amazon FBA, if anyone's doing it or needs more information on how to address that, let me know, because that is a big trigger in some states, and it's a hot issue. And right now it's still present, so we have to be aware of it. And then finally, the action plan going forward. These are complicated issues. There's a lot of complex state tax rules that need to be addressed depending on the state that you're looking for. You need to evaluate your systems internally. You need to determine your Nexus footprint of where it was now before you even add the employee, and what that will mean going forward. You have to determine if there's any taxability considerations for sales tax. If you have past exposure before you register, consider if you need a VDA or if you want to register, but consider what those applications are going to ask. They're going to ask you when you establish Nexus, a lot of them, and they're looking for information that to try to figure out if it's accurate or not. And then have a process for adding new states as employees look to move, and have a protocol. We have a matrix that we've built in-house to try to track where our employees are going and where we're proposing on jobs potentially in other states, and where we have Nexus and what our issues are and where we need to get compliant, and where it's like a wait and see because we haven't yet hit those thresholds. So there's a lot to think about. I'm coming up, I think 10 minutes left. So if any of you have questions, I want to leave enough time for questions.
Great, thanks, Kathy. The first question we have here is, do you have to withhold home city tax, or is an employer only required to withhold working city tax?
Well, that's what I mentioned in the Ohio until 12/31, and we're talking Ohio right now. Until 12/31 of this year, the employer can still use their employer location. But as of 1/1/2022, they're going to have to, if that employee is now permanently located in another city, that is where their withholding will have to come from.
Great. Next question we have here is, how many days would an employee need to work at the office versus remotely to qualify for withholding at the business office location?
That's a good question. I think so I'm not really sure how that's all going to work from a hybrid thing, because I think it's, if you're working in a location outside of your home office, I think it's like a 20-day, and then withholding in that, if it's a permanent move, then withholding would take place in that location. But if you're doing like 3 in the office and 2 at home, that's one of those things that I'm not really sure about, and I don't want to answer, but I will definitely get an answer on that one.
Great, and if anybody has any questions, be sure to send those in while we wait. Kathy, do you want to give us any final thoughts?
No, I'll just say, I threw a lot of content there and out there, and I know it's a complex issue and there's a lot to think about. And I would say, as an employee who likes to work remotely as much as I like to be in the office, like you want to give employees that benefit and that availability to be able to do it. But just be aware of the potential landmines by having people in other states, other cities, and what that means for your business, because you can't send out people 10 different states and not be able to understand what the implications of having people in those states can actually do for your business. So it's something you definitely want to stay atop on. I think states, the more I read where they are looking and how they're finding people, is very unique. I have a client who got a letter from California. They're a tiny business in the middle of Ohio, and California out of nowhere sends them a Nexus questionnaire. You would think, how the heck did they find them? They don't have Nexus, they don't have the sales, but California still found them. So you never know. So it's better to get a picture of where you are and then know how to make decisions moving forward and what effect it will have on you.
Awesome, thank you. We did get a lot of questions, so this is good. The next question we have here is, if you subcontract for another company in Pennsylvania, do you know if there is a tax situation for the Ohio subcontractor?
Yes. So if you have, if I'm understanding the question, so if you have a subcontractor, you're an Ohio company, if you have a subcontractor working for you on your behalf in Pennsylvania, you have Nexus. So you're not withholding because they're a subcontractor, but you would have Nexus for other taxes. They're acting on your behalf. There could be a taxable transaction depending on the service, what subcontractor they're doing, like is it repair, contracting? There could be some sales tax implications between the subcontractor and the owner, but it will trigger Nexus in Pennsylvania. So then you have to consider the other stuff in Pennsylvania.
Great, next question we have here is, we closed our physical office and now only have a PO box for mailing addresses. Do we use a lived-in tax for all remote employees?
Yeah, if you don't have a physical office, where people can report to, I think you'd have to use the withholding for wherever the person is located. So wherever your employees are located would be their withholding.
Next question we have here is, how does it work for multiple worksite report in EEO1? Do we put their home addresses in when we're reporting them?
That I'm not really sure about that question, so I'm gonna leave that one to later, but we'll figure out and get back.
Awesome. Next question we have here is, would paying sales commission to someone out of state and issuing a 1099 trigger Nexus?
Yes, independent contractors, independent agents, even if you're paying them through 1099, they're acting on your behalf in a different state, it's going to give you Nexus in that state. I think that's a widely misunderstood fact, because people think, oh, they're not related, they're an independent agent. I have sales reps all over the place. Well, those sales reps all over the place are giving you Nexus, especially for sales tax. It can be protected under 86-272 for income tax, but for sales tax, it does give you Nexus.
Next question we have here is, would paying sales commission to someone out of, oh, that's the same question. Let me move on to the next one. Should businesses be looking at Nexus if an employee is temporarily working out of state to visit friends or family? Example, 2 or 4 weeks.
So it depends on the state, and that's like the standard answer for every state question. But, so if they're working and it's 2 to 4 weeks, sometimes that is enough to give you Nexus. It would for sales tax. It's temporary. I think you have to consider all the situation. Do you have sales in that state? Is that person just doing drafting stuff, but there's no sales, no customers in that state? They're doing work for you in that state, but you don't have exposure. You might still qualify as having Nexus, and depending on the state payroll, you technically would have to withhold from that state if it's the certain state that says you have Nexus as soon as you're in the state for payroll taxes. So there's a lot of things you got to consider as to whether they have Nexus. And if it was COVID related, during the emergency action plans, it might not have qualified. Now, as we go back, you have to look at that one map that I had, the dates of when do you trigger Nexus for payroll tax, and then subsequently the other taxes.
All righty, last few questions here. If you drop ship for a distributor to a different state than the distributor is located in, do you need to collect tax exempt forms in each state that you are shipping to?
Again, it depends on the state. Drop shipping is really complicated, but when you're selling to somebody, like say you're selling to XYZ company in Nebraska, drop shipping to California, XYZ company should be giving you a California exemption certificate. They can't give you their home state of Nebraska, or you have to charge them California tax. So even though it's a clear resale, if there's certain states that won't accept a home state resale certificate, and you're left having XYZ company having to have the right certificate, or you have to charge them tax. So it can get very complicated.
Alrighty, and the last question here, does Nexus only come into play at 100K gross receipts?
It depends on the state, but that's the economic nexus. So if you're talking economic nexus is generally 100,000 of gross, but some states will include taxable or only count taxable. Some states will include just gross receipts. So it depends on the state.
Sorry, I was muted there. Okay, awesome. Thanks, Kathy. And thank you for joining us today for revealing the state and local tax consequences of a remote workforce, the digital age of state and local tax. We hope that Kathy was able to provide you with some valuable insight. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Kathy directly or any of our team members by clicking the People section of the firm's website at www.reacpa.com. That's REA. Don't forget to watch your inbox for your evaluation survey, access the recording of today's webinar, and more. Thank you, and we hope you have a great day.
Thank you.